Thank you for being here. It's pretty rare for you to join us for television. It's also remarkable that 8 years ago you started PJT, took it public, and now you've tripled your head count. You're much bigger than you were and are having a record half year at a time where most investment banks are facing a prolonged slump in revenue. So can you keep it up?
Well, I don't know if we can keep it up. We're going to certainly try to. But first of all, thank you for having me on this morning, Sonali. It's great to be here. It's almost 8 years, as you point out, and we have a plan, and we're just moving forward with the plan. But if you look at our first 6 months, it was driven by, we have a leading restructuring practice, and we're increasingly taking share from others, and we're trying to get at the forefront of liability management, trying to work with companies to re-equitize and restructure their balance sheets and deal with the fact that interest rates continue to grind higher. And we're growing out a leading strategic advisory business that's still in the early innings. So even though we're dealing with a lot of the same macro headwinds that others are, we're able to gain share and continue to move forward, and continue to advance our position.
We'll talk more about that restructuring wave because seriously, these idea of higher interest rates are going to have some impacts over a long period of time, but also remarkable is that you're hiring. You are hiring at a pretty rapid clip at a time when most investment banks are letting people go by the tens of thousands. How significant are your hiring plans this year?
Oh, they're quite significant. So if you take a step back, we have tripled our headcount in 8 years. We've tripled the revenues. Share price is up nearly 4 times. And if you look at the size we are today, we're still a half to a third the size of many of our direct competitors, and we're a fraction the size of the large banks. So we see tremendous opportunity to grow. This is an incredibly conducive environment to grow. You need to see M&A slow down in order to hire the best M&A bankers, and that's the ultimate paradox. And the reason for that, Sonali, is because the switching costs are much lower when you're dealing with a low velocity environment. Trying to get a best-in-class M&A banker to leave in the midst of an M&A bull run when they're loaded up with a whole host of mandates, the switching costs to extract themselves, they end up leaving their clients in the lurch. So we're taking advantage of the fact that even though the environment is quite challenging in the near term, we know it's going to inflect, we know it's going to come back, and we want to continue to press forward and continue to grow the franchise.
Is this going to be a record hiring year, and can some of this momentum continue even into next year?
Well, it's certainly going to be a record, and we intend to continue to press forward. Now, how many individuals we attract to the platform, really, we don't control fully, because at the end of the day, we have a very clear sense as to who would work well on the platform, who's best in breed, who's best in class, who shares our vision, shares our values, and you cannot end up turning this into a quota as to how many you hire each year. But there's no doubt that we're still relatively small compared to the opportunity set. So if you ask me, are we going to be much larger 3-5 years from now? The answer is absolutely.
Bring us under the hood, because it's a pretty fascinating dynamic. You have such high-profile bankers leaving Goldman Sachs and Credit Suisse, all for different reasons. And so what are bankers telling you as you're having these conversations?
Well, if you step way back, there are a few trends which have been in evidence for the last decade. The first is that increasingly clients want to work with smaller firms. And we started to see that coming out of the global financial crisis. That's only picked up speed over time. So that's the first point, is you need to have buy-in from your client base. I think the second, which is a corollary trend that most individuals didn't really pick up on, is if the most sophisticated, consequential companies around the globe are going to work with smaller firms, they're going to expect the sophistication of a larger firm. So that means you need to continue to build out the breadth of services, the caliber of individual. You need to make sure that you can follow your clients anywhere around the globe. So those two things have continued to prove out. And as bankers at bulge bracket firms increasingly see that their clients would be highly supportive of a move to a smaller firm, the question becomes, what's the catalyst? What's going to get you out of a comfortable position to take a jump, take a leap, do something different? And I like to say that we're in that exquisite sweet spot, which is we're big enough so that no one's going to miss a beat. They're going to have access to working with some of the most sophisticated colleagues around the globe, but we have so much white space that they can get in early, not be jockeying for position, and do what they love to do, which is be bankers, not managers.
Speaking of being a banker, bankers have been griping a lot on Wall Street.
Always.
Always about everything. But when you think about what they're actually talking about now, it's return to work. How often do they have to be in the building, and how flexible do you have to be to keep them around?
Well, that's a great question. I made a commitment in the depths of COVID of two things. One was we were learning so much from how to work remotely that we were never going back precisely to how we did work pre-COVID. On the other hand, if you're not in the office most of the time, and if you're not creating those personal connections, and if you're not learning through an apprenticeship model, you're not doing it the right way. So what we've been continuing to evolve to is a model which starts with being in the office, because that's where you learn. That's the best way to support the clients. That's the best way to train and develop individuals. And there's no latitude for people not being back in the office. Having said that, you can't allow technology to continue to invade your personal space, be on call 7 days a week, be expected to get on a Zoom call on a moment's notice, and not have some release valve. So what we did about a year ago was we turned Fridays in office to be optional. You could work from home on Fridays, but work from home starts with work. You may be home, but you're working. And in the dog days of summer, which is after the summer interns leave until Labor Day, we also have a work from home option. And I think by acknowledging that we can use technology to be more productive, but making the centrality of being in the office, we can try and find that sweet spot.
It's about to get busier slowly after a big deal slump. How fast do you actually expect mergers and acquisitions to start coming back to the market?
The pace of activity and dialogue is clearly picking up. We're looking at levels today that we haven't seen in more than a decade. So M&A volumes today are not much greater than they were coming out of the global financial crisis. If you benchmark it relative to GDP or market capitalizations, it's at lows we haven't seen, I think, ever. So I'm not really going out on a limb by saying it's going to get better from where we are today. There's no doubt about that. It can't get worse. There's an old saying, you can't get hurt jumping out of a basement. I don't think we are in danger of going lower than where we are today. The question is, how quickly does it inflect? And one of the things about M&A is it's a pro-cyclical business. Transaction activity begets more transaction activity. There's the ultimate FOMO, fear of missing out, which is if your competitor is transacting, if they're growing, if they're investing, if another private equity firm in the alternative space is committing capital, it tends to lead to more activity. I think we have the conditions that are nearly ripe for that. And it wouldn't surprise me if sometime between now and the end of the year, you see a very sharp inflection.
There is one place things could get worse, that is with restructuring. Higher interest rates, a whole bunch of forces that are pushing companies to either restructure or go bankrupt. How significant is this wave of distress going to be? What does it look like?
Well, I think we're in for an extended wave of elevated restructuring relative to where we are today. But where we are today is at historic lows in terms of default rates and the like. We're still feasting off of the easy money environment, relatively low interest rates, but there's a day of reckoning, and we're going to see a meaningful uptick in restructuring activity. But again, to put it in perspective, that's relative to historic lows. And I often get asked the question, can an upswing in M&A coexist with an upswing in restructuring? And my answer is pretty simple, is right now, they're both at historic lows. We're seeing historically low default rates, and we're seeing historically low M&A volumes. And I think both of them can sort of snap back more to traditional long-term levels, and both start to be engines for our firm.
Now, Paul, before you left and started PJT, you were very senior at Morgan Stanley. You were seen as the CEO candidate. Now, fast forward more than 8 years, and you have Morgan Stanley going through its own CEO transition. What do you think the future of Morgan Stanley looks like?
Look, I think James has done a terrific job. I think the firm, is firing on all cylinders, notwithstanding the difficult macro backdrop, and I have no doubt that they'll continue to thrive going forward. I think the question for our firm is, what do we do and how do we thrive going forward? And I'm confident that we have so much open running space ahead of us that, that's what I'm focused on. That's where my attention is.
Are you thinking about number 2 already?
I'm always thinking about
Who's
succession.
taking over?
I'm always thinking about, who's going to succeed me, because we're building this firm to last, to be durable, to be sustainable, and that means that you need to be able to train, develop a next generation. Most of our growth has come from external candidates, but that's reflective of the fact that we're only 8 years old. But the goal is, over the next 8 years, as more and more of those individuals who join at the most entry-level positions, they get to grow up in our firm. They're trained, they're developed to be the world-class banker, and they have only one home, and that's PJT. So that's what I'm focused on.
Speaking of, this is the last week for the interns. The interns are starting to, leave Manhattan now and all the cities they're in. Do you have any advice for them? Because there is a lot of anxiety about what jobs they can get coming out of these cycles.
Well, it's crazy. We have at our firm nearly 100 summer interns around the globe. And that's about 1% of the resumes that we get. We get close to 10,000 applications every year, and about 100 show up at our firm for the summer. And one of the things that we've initiated, which I think is terrific, is that at the end of the program, every one of our interns is obligated to then spend time doing community service in a project of their choice. And to me, that's one of the things that I would tell everyone on Wall Street to take away, which is you can go at it really hard, be very focused on your career, but there's a bigger world out there, you're part of a broader community, and find a way to do something to give back to your community.
Bankers are people too, right?
Yes, absolutely.